Traditional fixed income relies on a simple assumption: buy a bond, hold it to maturity, and collect a static, predictable coupon. That hold to maturity strategy carries an inherent vulnerability. As macroeconomic environments shift, a static portfolio absorbs the impact of interest rates and inflation without a mechanism to adapt. Remaining static in a shifting rate environment leaves money on the table. This is where active management steps in to capture alpha, the engineered excess return generated above and beyond a bond's fixed coupon rate. Portfolio managers operate as active traders, capitalizing on secondary market movements long before a bond ever matures. While a passive index generates a flat baseline yield, a tactical traded portfolio captures compounding outperformance by treating bonds as liquid, tradable instruments. A bond's yield is mathematically fixed at issuance, but a portfolio's total return is engineered in the secondary market. Active fixed income relies on a single axiom: the bond market is not perfectly efficient. Managers exploit two specific market failures. The first is mispricing, where individual bond instruments deviate from their true fundamental value. These pricing anomalies create windows where functionally identical assets trade at different values. The second failure involves consensus errors, where the broader market incorrectly prices future macroeconomic factors. The collective assumptions regarding future interest rate trajectories are often flawed, creating a margin of opportunity for a manager who predicts the true trajectory accurately. The strategy is built on locating exactly where the market is mathematically wrong and positioning capital to profit when reality corrects the error. The first tool in the kit is duration, the mathematical measure of a bond's price sensitivity to changes in global interest rates. This relationship follows a foundational rule of bond mechanics. As interest rates on the x-axis fall, bond prices on the y-axis rise. Consider a scenario where a portfolio manager accurately anticipates an impending drop in central bank interest rates. They execute a duration switch. By selling low-duration short-term bonds and buying high-duration long-term bonds, they maximize the portfolio sensitivity to that rate drop, multiplying capital appreciation. If rates are expected to rise, the manager shortens duration. This minimizes price decay and protects underlying capital, while a static index takes the full hit. Duration switching converts abstract macroeconomic forecasting into direct capital preservation and appreciation. This curve visualizes the market's consensus on interest rates across different loan maturities. For this strategy, the yield curve must be upward sloping, meaning long-term debt yields more than short-term debt. Execution begins with the purchase of a high-yielding long-term bond at the peak of the curve. The manager has no intention of holding this bond to maturity. As time passes, the bond's remaining time to maturity decreases. Mechanically, it rolls down the yield curve. Moving towards shorter maturities causes the yield required by the market to drop. Because falling yields result in rising prices, this geometric slide generates a capital gain above the regular coupon payout. Riding the curve exploits the passage of time, turning the structural geometry of interest rates into tangible excess returns. Bond switching is the rapid exchange of one bond for another to capture immediate relative value pricing advantages. Anomaly switching targets two bonds that are nearly identical, same maturity, same coupon, and same credit rating. When pricing dislocations occur, one bond becomes comparatively cheap, while the other remains expensive. The manager sells the expensive asset to buy the cheap one, capturing that mispricing as pure arbitrage. Policy switching transitions from microanomalies to broader macroeconomic shifts. This is triggered by anticipated structural changes, such as shifting central bank rates or broad credit rating upgrades. The manager swaps dissimilar assets to front-run these changes before the rest of the market prices them in. Anomaly switching is a micro-market correction, whereas policy switching is a calculated macro-market prediction. Intermarket spread switching moves capital across entirely different bond sectors. The spread is the yield difference investors demand as compensation for taking on corporate credit risk compared to a risk-free government bond. This strategy relies on predicting when the specific spread will widen or narrow based on economic cycles. Shifting capital between these sectors locks in the most advantageous spread before the market shifts. Sector-level credit risk becomes a predictable alpha opportunity. Successful fixed income requires continuous, calculated engineering. Managers shift duration for rate moves, ride the curve for capital gains, and execute swaps to exploit pricing anomalies.
These strategies are possible because the bond market is inherently imperfect. The mandate is to locate where the market's implied view is mathematically incorrect. Active fixed income is a precise engineering discipline, positioning a portfolio to force excess returns the moment market inefficiencies correct themselves.